IPAD 744. I wanted to talk today about the issues of accounting because they're embedded in our process here of budgeting. So it's important we understand how the accountants who have to follow a lot of rules and regulations will interpret ultimately the budgets, they will evaluate the budgets after the end of the budget cycle, and will give us the quantitative analysis needed so that we can initially formulate budgets and assess what is going on. So, as you know, accountants um, follow two different sets of standard accounting protocols. One is called a cash basis form of accounting, where we follow the cash and is often referred to as single entry. And the other is called an accrual basis of accounting, where we follow the accounts, and cash is just only one account, and that is considered a double entry type of accounting. And most systems in place use, most standard organizations use an accrual basis because it allows you to really keep track of very complex transactions, which most organizations have. Where the cash, things are happening with the cash at a different time than are happening with the contractual obligations or the goods and services being received or being delivered. So it's all about keeping track of transactions. And the accountants, as you know or may not know, they are all governed by a set of standards and protocols. So accountants follow what's called GAAP, Generally Accepted Accounting Principles, GAAP. And these are governed by different organizations such as the FASB, Financial Accounting Standards Board, or GASB, Government Accounting Standards Board. And they basically establish the protocols by which all organizations then adjust their accounting practices. And it's important to understand this because when the rules change, it changes the way we understand what is going on or the way information is communicated to the public. So very important to understand. And the other thing that we're looking at that's part of this process are the two financial statements that are generated at either the end of each accounting year or at any given point. There's the balance sheet, which is considered a snapshot of the financial state of the organization. And that shows you at any given moment what is the net worth of the organization. It's the equation is considered assets minus liabilities equals owner's equity or net worth, or the other way of putting it is assets equals liabilities plus owner's equity or net worth. And it shows you at any given moment what the net worth is. So if I were to ask each one of you, what is your net worth? You might start with, well, I have this much cash in the bank. I am owed this much money. I have this amount of capital assets. Capital assets are things of worth that are non-tangible. They're not, money. So a car, a house, a big piece of equipment. Um, you might own something, some sort of valuable piece of art. Another asset might be your pension, even though you might not have control over it. You know that you have an account somewhere. Good idea to keep track of that. So these are what everyone's assets are. And then liabilities are monies or obligations that we owe, or once again, contractual. So how much money do you owe? And this could include credit card debt, house loans, auto loans, insurance. You make a contract for a year on your house or your car and you pay it every month. That's a liability. And the difference between the two is your net worth. And governments have that as well. And it is the only way to keep track of the differences between when the time lag between when things happen and when they're actually paid for, and cash is just one account. And the other statement that's of interest to us is the income statement, which the equation for that is revenues minus expenses equals profit or loss, or revenues minus expenses equals surplus or deficit. So it tells us how much money has come into the organization on a given year, and how much expenses have we had, and at the end of the year, do we have a surplus or deficit? And we know that it's our obligation, usually in public sector organizations, one is given money with the expectation it will be spent in a certain time period. And so everyone tries to be what they call conservative in their budgeting practices, which means conservative means a little bit different than it means in politics. In this case, it means that we underestimate by a smidgen the revenues and overestimate by a smidgen the expenses. And then we continually adjust this as the year goes by so that at the end of the year, all the revenues have been spent and we have not gone over in terms of expenses, or else we have a deficit, and that's a problem. And as you know, most states or most places have a requirement that the budget be balanced before it is passed. So a lot of times a budget is only balanced that moment that it is passed, and then it immediately goes kaflooey. But anyway, so it's important to understand these two statements, and then today, where the assignments are really talking about the difference between accrual versus cash accounting and the implications for that, because there are many liabilities that governments have that are not necessarily seen by the public. And the public now wants to know about them. It's important to know when you make contractual arrangements with the people who work for you, or when you build a bridge or a tunnel, like what's it going to cost you over time? And then how much money does your municipality or your organization owe? Because that influences then how much debt payment you will have on the operating budget. And it will also influence how much money you can borrow. So these are just some thoughts for today. Take a look at the assignments, and we'll talk more about it.